I happen to be a kick-ass accountant.
What's up, everybody? It's Ryan, and I am back to talk about the Accounting 240 course pack, Chapter 3, Problem number 6. It's a big one. Let's get into it. Hey, so first up, let's read a little bit through the narrative of the problem. Then we're going to jump into the Excel where I have pre-populated some of the responses, and I'm going to talk my way through the 5 years involved in this CCA calculation. So we have problem 6. Louis Pizza. Louis Pizza started business on April the 1st of 2016. April Fools. April Fools, guys. They have a December 31 year end. Hey, anytime that you see a business is starting, make sure you think about prorating CCA if there are any capital assets bought in this year. Louis uses a fleet of delivery vans, and the following is information about the fleet. So we see we've got 2016, 2017, 2018, 2019, 2020, and in each one of those years, some purchases are made, probably some dispositions as well. Now, I'm not going to read through all of that right now. I'll pop back and forth because it's just a little bit easier to do 1 year at a time. And that's how I suggest that you handle something like this. Absolutely do it year 1, year 2, year 3, year 4. And you can set up a little grid so that you can tackle something like this. Now, the required here that you should read many times, calculate the maximum CCA deductible for each of the years, maximum CCA. Remember, CCA is a discretionary deduction, meaning if you don't want to, you don't have to take it. But why wouldn't you want to? Because it's a freaking deduction from your net income for tax purposes. So we're going to assume the maximum from 2016 through the current year. All right. Let's do it. So first up, we are going to tackle the year 2016. So here I am over here in 2016. Now the class number for delivery vans it's automotive equipment, and each individual one is not going to go into its own class 10 because 10.1, I should say. Each one of these vans costs well under $30,000. So class 10 is 30%. I like to write that at the top so that I don't forget. UCC at the beginning of the year is not anything. So we're going to have some additions during the year. So I'll pop over here and I'll say 10 vans were purchased at various times through the year for $9,500 each for a total of $95,000. Are you kidding me? You're getting a delivery van for under 10. Wow. Okay. Doesn't matter. We've got additions during the year of $95,000. No problem. We don't have any disposals during the year. All we have are those additions. So we're going to carry our balance through, and then we're going to take a look at, well, we're going to have to apply this half year sort of rule. The reason being that the reason we're doing the half year rule in 2016 is that it is prior to November the 27th of 2018. Any acquisitions prior to that date are subject to the half year rule. Any acquisitions subsequent to that date are subject to the accelerated rate. So here we're going to have the half year rule. So what I'm going to do is subtract half of the net additions. The net additions, because we don't have any disposals, are $95,000. Half of that is coming out of the pool. The amount now that's subject to CCA is half of that, $47,500. So we need to calculate the CCA for the year, but I'm going to scroll down to this little note that I've come up with here. The reason for that is because, and you should know why, but that's okay if you don't by this point, is that it's the first year of business as mentioned earlier. So what has to happen is we have to prorate CCA for the time that the business started up during the year, right? So you prorate the CCA for the amount of days in the year that the business has actually been operational for. So we'll do a quick little calculation here. This is what the CCA would be in the absence of any proration. It's the 47,500 times 30%. That's the number we get right here. We now have to prorate for the number of days remaining in the year from April 1st to December the 31st. You can see right here, April the 1st to December the 31st is around 275 days. You know, you can count it out. Maybe you're plus one, maybe you're plus minus, whatever, 275 days. We're going to take 275. We're going to divide by 365. That's going to give us a percentage. We're going to multiply that percentage that we're going to prorate 14,250 by. And hey, guess what? The CCA that we're going to be able to take this year is $10,736. I'm going to fly back up to my spreadsheet here. And I'm going to insert that. Remember, it's a negative number because we're subtracting it. We do have to add back the 1/2 net amount that we deducted earlier on, $47,500. And our UCC for the end of the year should be $84,264. Great. That's year one in the can. Now we're going to have to take a look at year two. So we head back over to our problem narrative. So here's 2017. We buy 2 more vans. Louis Pizza buys 2 more vans. Oh, the price has gone up. Now they're $10,000 each. So we have additions of 20 grand. No problem. I'm going to start off now in the year 2017. Now, the UCC at the beginning of the year is the closing balance of the prior year, and that's 84,264. We have some additions during the year of 20 grand. And our balance that we're going to be working with going forward, because there are no disposals, is simply the addition of those 2 numbers. Now we have net additions for the year, meaning we have a positive amount of additions. The net additions were 20 grand. 1/2 of that, because we're still prior to November 27th of 2018, is going to be subtracted. And here we go. It's $10,000 that come out of the pool temporarily. That $10,000 has to go in. The reason we take out the $10,000 is so that we can multiply, we can determine that half year rule, the half amount of CCA on the additions that you would otherwise take. So we're going to follow along here by the 104 minus the 10. This is the amount that's subject to CCA. There is no prorating this year. No prorating, only in the first year of business and the last year of business. So we'll just take our 94 grand times 30%. That's going to give us 28,000 and change worth of CCA. I'm going to have to add back that 1/2 net amount, and we're cooking here with gas. We've got $75,985. Hey, just so you know, I don't skip over it. If you scroll down a bit, you can see that, in fact, I did do a little bit of a note on the first year, right? So it talks about, if you're like, I still don't understand what that guy's talking about, you can read through the little note here. It's in your solution as well. And it talks about why we do that. All right, let's head back on up to our beautiful little grid that we've got going on here. And we're looking at 2018. So let's go back to the problem narrative. 2018 says, well, there are 3 vans purchased in 2016. Oh, 3 vans. Aha, 3 vans that were purchased in 2016. It looks like they've been well maintained. They sold in November. They were sold in November for $10,000 each, meaning we're going to have a disposition or disposal of $30,000. So when we are going to remove an amount from the pool, let's just carry forward our balances first. So we go over here to 2018. We have an opening balance, which was the same as the closing balance of $75,985. We have no additions during this year, but we do have disposals during the year. Now, how are we going to figure out those disposals? I made a little comment on it down below, but you know what we take out of the pool is the lower of cost or proceeds. We need to know the cost of 3 of those delivery vans. We know the proceeds. It's $30,000. I know what it's going to be right now, but let's just walk through it with you guys. So let's see if we can see it here. There it is. So it's this note that I've got going on right here. I guess I'll highlight it in the lovely yellow. Disposals in year 3 are the lower of cost, $9,500, and proceeds, $10,000. So in fact, the lower of those 2 things is 95 grand. We times that by 3. That gives us 28,500. That is what we are removing from our UCC pool. And there it is, 28,500 comes out of the pool. Then we're going to jump over here and give us a little bit of a summary of the balance. Now, we do not do anything with the 1/2 net amount. The reason that we don't is because we do not have net additions. We have net dispositions. The only time you employ the half amount, the 1/2 net amount, is on net additions. We don't have that. This is one of the most common mistakes I see on exams, is that people see a number there and they multiply it by 1/2 and they dump it in. No, only if your net additions are positive. So because they aren't, we do nothing. So what happens is we'll carry our balance forward. 4745, we'll multiply that by 30%. That's going to give us our CCA for the year, 14,425. We do nothing with the net amount. That's not a thing that happens. And we simply tally up the balance here. And we've got 33 grand for the year 3. Okay, I do talk about the half-year rule down below. If you'd like to take a look at that, there are no additions, or there's no net additions. Now that's in year 3. We'll find that in year 4 it's similar. But don't take my word for it. Let's read the problem narrative. Hey, it's 2019, guys. 5 more vans that were purchased in 2016 are sold in February for $7 grand each, meaning we have a total of $35,000. That is the proceeds of disposition. Once again, when we go to dispose of some assets in 2019, let's take a look. First off, we'll carry forward the balance from the prior year. And then again, like I said, we have some disposals during the year. I did a little note for it down here. Note for disposals in the year. Disposals in year 4 are the lower, again, of cost or proceeds. So the cost of each one of these things was $9,500. The proceeds on each of these things was $7,000 each. The lower is the $7,000 each. We multiply that by the 5 vans. We get $35,000. That's what comes out of our UCC pool. So I'm going to scroll on up. I'm going to plug in a minus 35 and OMFG. Look what we got. We got a negative balance. And you should be excited about this because the second you see a negative balance, you know exactly what you've got. And that's a little something we call recapture. So here we've got recapture. You cannot have a negative balance at the end of the year. If you do have a negative balance at the end of the year, you've done something wrong, right? This needs to come out of here. So the amount subject to CCA is nothing. You do not take CCA when you have recapture. What are you going to do? Times a negative number by a percentage? You just have a negative number. Weird. Don't do that. We are going to add back now. There's no CCA for the year. That's not something that's calculated, but we do, and we don't have a net amount for the year at all. But what I do have to chuck in here, and I didn't really include before, but I'm going to do it right now, is we're going to do an add back of recapture. Add back recapture. We don't see that on every single one of these problems, and we certainly don't need to address it in years 1, 2, and 3, but we do need to do it here, and we will have an add back. Remember, we're adding this back. Why are we adding it back? Or what happens here with the recapture, it's an income inclusion. This is an income inclusion. Makes income go higher. Makes tax higher, makes Ryan cry, makes Louis cry. Ryan doesn't care, he's impartial here. Okay, so what's the balance at the end of the year? Well, negative 1761 plus positive 1761 is a big fat zilch. So we got 0 going on here. Now let's close this puppy out by taking a look at 2020. We're gonna roll over to our narrative again. 2020, 2 vans are purchased for 22 grand each. What the hell is with these vans? They're $9,500, then they're $10,000, and all of a sudden they're $22,000. Okay, they're super awesome vans. So there's additions of $44,000. You know what to do. Let's go do it. So first up, we have 0 balance opening of UCC in class 10, 2020, because everything's gone last year. Now, when I say everything's gone, ooh, is everything gone? Let's see, I bought 10 vans, then I bought 2 more. I had 12 vans. I sold 3 vans. So now I'm down to what? 9 vans. Then I sold 5 more vans. I got 4 vans left at this point. And there's nothing in the UCC pool. Who cares? You can have assets in a pool that have a 0 balance. All it means is that you can't deduct CCA. You done deducted all the CCA. Ergo, we have a 0 balance, but we still have some bunch of trucks in there. Well, great. We're buying 2 more trucks. Or vans. So I'm going to add in the 44 grand here. And then I'm going to, guess what? This number is going to be 44 grand. I have positive net additions. The net additions are 44. Half of that is 22. Now, up until this point, what we've done is deduct 1/2 net additions. But because we are now in the year 2020, which is after the year 2018. That's how the space-time continuum works. So we got year 2020. Instead of deducting the 22 grand, we are going to add in the $22,000 because things change in tax. That's why it's so exciting. That's why I teach it, because it's a dynamic subject, unlike accounting, which is the same old S every single year. Back to our spreadsheet here. We got 66 grand is what's subject to CCA. We times that by the 30%. That gives us our $19,800 of capital cost allowance for the year. We got no recapture, don't have to do nothing with that. I'm going to now deduct the amount of the 1/2 net additions that I had added in before. That 22,000 that we added in does not represent an additional amount of UCC that we can actually amortize, right? It's just put in there to artificially inflate the balance so that we can multiply our accelerated rate. And then we got to take it back out again. So we took it back out. And then we're going to take a look at what we have for a closing balance of UCC, which is $24,200. That would roll forward to 2021 if we were going to do 2021, but we're not because it's over. We finished this. Take away from this, if you want to look this thing over, we've got some CCA here. So it asks for the maximum CCA. That's the CCA for all, that's the CCA deduction for all 5 of the years. There is no deduction in, of course, the year 2019. We have an actual inclusion in income. And I think that's all she wrote for this one, folks. So it is legitimately over. We're finished now. I'll see you guys for the next one. I can't wait till we meet again. Bye. Thanks for watching my video. Did you like it? If you did, press the like button. Did you find it helpful? Well, there are plenty more videos right up here. If you really found it helpful and you want to be updated on all the latest videos, why not hit subscribe? Right over there. All right, everyone. See you next time.